of the market sentiment for the international oil market. In this report, we aim to shed light on the factors driving WTI's price over the past week and assess its future outlook. Oil prices had started to stabilize in the late American session on Friday, also for technical reasons, as the downward movement of WTI's price started to seem a bit overstretched. It should be noted that even the widely better than expected NFP figure that implied a relatively tight US employment market failed to provide support for the USD and in that way to weigh on oil prices. Hence, last week ended with some hesitation on behalf of oil bears to continue. On Saturday early morning, the dramatic raid of Hamas over Israeli territory took place, which shook the world and tended to create substantial worries in the oil market as well. The fear of an escalation of the crisis at an international level, with other Arab countries taking part in the conflict, understandably intensified market worries for further tightening of the supply side of the international market. As a consequence, on Monday's opening, demand for oil surged substantially and pushed oil prices higher by more than $3 per barrel, allowing for WTI prices to stabilize at around $84.50 per barrel for the next couple of days. Yet market worries for possible further tightening of the supply side of the international oil market tended to ease on Wednesday, practically allowing for oil prices to drop near, yet just above, Friday's closing level. Analysts tend to highlight as the main factor behind the drop Saudi Arabia's pledge to help stabilize the oil market. Yet at this point we should note that Russia seems also to be taking part in this effort. Yet with all the sanctions set on Russian oil, the effect may be limited. The main point of interest remains Saudi Arabia, given its proximity geographically and culturally to the Palestinians, but also its position as the main OPEC oil producer and its lowered production levels. Yet the drop of oil prices on Wednesday may also have been maintained by the release of the AP weekly US crude oil inventories. The report showed an increase of US oil inventories by 12.9 million barrels, while EIA is also expected to show an increase, yet far narrower. Should also EIA indicate an increase in US oil inventories, that would imply that demand was not able to catch up with production levels, thus implying a slack in the US oil market that may weigh somewhat on oil prices. During today's European session, we note that both Brent and WTI prices rose simultaneously as OPEC stuck to its forecast for a robust oil demand at an international level, with consumption being estimated at 2.44 million barrels per day in 2023 and a bit lower at 2.25 million barrels per day in the coming year. Yet at this point, we note that OPEC's forecasts tend to collide with EIA, which expects an easing of oil demand in the coming year due to worse conditions in China, India and Brazil. May we also note here that the German government is now expecting the economy to shrink by 0.4% this year, implying a recession, and the situation could be regarded as indicative of Europe and thus may weigh on oil demand as well. For the time being, the situation in the international oil market tends to be quite fragile. Fundamentals that traditionally surround the oil market have become more complex, with the conflict in Israel, and the market is still having a wary eye over the situation there and how it could affect oil prices. We still consider that a possible escalation of the war in Israel, especially if neighboring Arab countries are to take part directly or indirectly, may have a bullish effect on oil prices, as market worries for the supply side of oil are expected to intensify. On the demand side, we would highlight any signs of increased economic activity in China that may provide some support for oil prices and vice versa. Also, we would note that the possibility of a tight financial environment in various countries could have an adverse effect on economic activity and weigh on oil demand.